Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello, and welcome to Business Line's State of the Economy podcast series. This is the series focusing exclusively on the markets, and this has been coming to you regularly for just over a year now. Bringing insights from market experts is your host, Parvatha Vardhini. I am the editor of bl.portfolio, Business Line's Sunday feature on investments and personal finance. The expert speaker for this month is Mr. Nimesh Chandan, Chief Investment Officer, Bajaj Finserv Asset Management. Nimesh has been part of the mutual fund industry for 17 years, where he has managed products across market caps and themes and developed models on sustainable investing, quant investing, and asset allocation. Prior to joining Bajaj Finserv AMC, Nimesh was head investments equities at Canara Robeco AMC. Hi, Nimesh. Welcome to the podcast.
Hi, Vardhini. A pleasure to be here on your podcast.
Great. So I think it's been a very good time for the markets, barring, say, the last month or so, isn't it? So you must have been very busy, although, Bajaj Finserv per se has been a late entrant. You could still, I guess, garner a lot of inflows.
Well, we say that we have a late mover advantage, actually, rather than being a late mover. So, see, the mutual fund industry has many, many years of growth ahead. So probably we'll become twice the size by the time we are in 2030. And many more years to grow from there on. And worldwide also, when we've seen markets, we see the mutual fund industry having much higher penetration in, say, developed markets like US, Europe, even in areas like China, Singapore, these places in Asia. There are many, many AMCs, and the penetration of mutual funds as an investment vehicle is very, very high. So I think in India, even while the journey has been so great, we are just at the beginning. And what we believe is we are bringing some differentiators to the market. If you see our investment philosophy, for example, so here we call it the InQ, which is a combination of information edge, quantitative edge, and a behavioral edge. So in our investment philosophy itself, we talk about how we will outperform the market or how we'll do better than the crowd and create long-term wealth for our investors. So there are only three ways that you do better than the crowd. Either you have superior information, or you have superior analytical models or quant models that help you process that information. And the third is a behavioral edge, how you react to the output of this quantitative models. So we try to combine all the three and create an edge in the market. Even if you see our products, we have brought products which are kind of a first-time intro into India. The first equity fund that we launched, our FlexiCap fund, is based on a strategy called mega trends investing, where we identify mega trends that will unfold over the years and identify companies that can benefit from them. In our large and mid-cap category, we came out with moat investing, which is about analyzing companies on qualitative basis, which is their competitive advantage that they have, and create a strong portfolio of robust businesses there. So in every fund that we are launching, we try to bring some differentiation. And in our processes also, you will find that we use a lot of behavioral finance tools to improve our decision-making and take advantage of the crowd's overreaction and underreaction.
Okay, that's great. Mega trends is quite interesting, but to what extent do you think are these mega trends left undiscovered? Or probably you would want to describe what your mega trends are and then, say how you would use it to your advantage.
So the genesis of this idea was that you'll remember, our grandfathers, when they were investing, they used to say buy and hold is the right strategy for equities. Now, buy and hold is good. Long-term perspective on equities is good. But you will see in the last few years, we are going through so many changes either technology changes, regulatory changes, economic changes, where if you're holding a company or a asset class for a longer duration, in some years, because of these mega trend changes, the case to be invested in them may change. So buy and hold actually has become buy and watch. So you have to keep track of these changes. And one way to do a tracking of these changes is to look at sources of mega trends. Businesses, economies, corporates go through changes based on a few sources of change. There could be technology changes, regulatory changes, economic changes, nature or sustainability related changes, demographic changes, and social changes. So we put this into an acronym called TRENDS, trends, which are the 6 sources of trends. We identify from each segment what changes are coming about. We look for trends which will last for at least 3 to 5 years, and then see which are the companies that can capitalize on these trends and which are the companies that may be against these trends.
Okay. So, these, in terms of themes, I mean, could you put names to these mega trends? And do you think it is still left undiscovered by the others? They may not be calling it, but I guess they would still be investing in the stocks which are driving these themes.
So when people do investing based on trends actually, or based on the future, they typically project growth rate for each company. So that is called growth investing, where you're giving a lot of value to the company's future growth. Unfortunately, growth investing in its purest sense has a couple of downsides also, because you're putting so much faith on future growth and giving high valuation on there. It is possible that you may go wrong in that forecast, and you may actually suffer not only downgrade in earnings, but you also suffer severe derating, as the future did not turn out to be how you expected.
Mm-hmm.
Now, using mega trends as a strategy, you actually get more visible growth rates for the companies that you're analyzing. So let's take, for example, within auto sector, electric vehicles. Now, this is a trend which there is a support from technology changes. There's a support from regulatory changes. The government also wants you to focus on having less polluting vehicles. And environmental changes also push for EVs. Now, if the theme as an electric vehicle, companies associated with them have a tailwind to grow at 25-30% compounded, say, over the next 5 years, the company has to do very little in terms of management to outperform this trend. They will have a high growth rate visible over the years. Now, let's look at some other sides which may be against the regulatory or technology changes. So let's take, for example, certain products in the pesticides or insecticide segment. Now, obviously, there are certain healthcare issues where people don't want much of insecticides or pesticide-laden food on their plate. So the customer is demanding it. Second, there are technology changes coming in the seeds business, where there are many companies that make seeds which are immune to certain diseases. So the plant grows immune to certain diseases, the number of sprays of pesticides will go down. So now this is a trend which is against some of the categories of these pesticides and insecticides. For them, those companies to grow even at 8-10%, it will take a lot of effort. Either they diversify or they acquire other companies and so on. So focusing on mega trends, you actually have more visibility about future growth rates, and then you are comfortable giving it a higher valuation.
Okay.
In fact, most of the people start from the company level and then look at what industry growth rate will be. As they call it as a bottom-up investing. We look at creating a top-down way of looking at companies, that companies, rising tide will raise all these boats. Let's identify which is that universe and focus more on them.
Okay, I think that was a very clear explanation of how you would invest in a mega trend. This is more long term. Coming to the very short term or the near term. So if you see Nifty FMCG versus the Nifty, surprisingly FMCG is down in the last 1 month compared to the Nifty. So And all these, starting right from HUL, everybody's commentary has been very negative on consumption. So, and you are coming out with the consumption NFO, I think. I just looked it up. So, so what is your take based on what companies are saying, and, how, what is the level of conviction that you have that, in this theme for the near term?
So, Vardhini, as you would know, some of the best investments by some of the marquee investors are made when certain set of companies or a certain company which has a very strong long-term growth outlook, but goes through a temporary downturn, where for a quarter or two, they are going through some problems or they're going through some slowdown. The longer-term story is very attractive, but they are going through this downturn. Because most of the investors or traders in the market are impatient or they look at very short-term numbers, they overreact on the downside of them. So you get an opportunity to pick up fantastic businesses at excellent valuations also. Now, to give you an example here, for most FMCG companies, you'll find the commentary saying that the rural growth has been quite good. The urban growth has been slow for them.
Right.
This is a cyclical issue. On the urban side also, incomes are growing. Now you see even the hiring numbers coming from IT companies and some of the other financial sectors and all doing very well. In fact, some companies that come out with their job index and all, you will find them showing that there is an uptick now in pickup. Also, because of certain seasonality factors, dates of certain festivals, there could be a certain delay in these consumptions. FMCG is staples, right? People will keep consuming more and more in terms of frequency. People will keep premiumizing as the income levels rise. So it's a good long-term story, but going through a temporary, a quarter or two of slowdown. And which is why you're getting them at fantastic valuations. In fact, some of the FMCG majors are having double the dividend yield of Nifty. So it's that kind of attractive numbers that they are in.
No, I don't know. When we say fantastic valuations, we are so used to FMCG being at very high valuations. So when they contract a little, we think, but per se, if you see, it is not cheap.
So even in historical, if you compare to FMCG's own valuations, they are at a lower end of their valuation. When you compare to the premium they enjoy over Nifty and the broader market, that has also shrunk significantly. Now, why should these companies deserve a premium? All these companies have very strong competitive advantage. Their brands are extremely strong. Their cost structures are extremely agile. If you look at any FMCG company, you will surely find them with excess cash or high cash on their books. They are good dividend payers. They have steady growth. So consumer habits regarding FMCG don't change very quickly. So many of them have dominant positions and market shares, which they sustain over a longer period of time. So these companies deserve a premium on that because I can forecast a 10-year growth for these companies very confidently compared to, say, a company which is doing projects. They may have an order book for next year and at max the year after. But what after that? So these companies with strong balance sheets, long runway for growth, higher cash on their books, higher dividend payouts, they deserve a premium over the rest of the market. If you take the whole consumption space, actually the structural driver is India's per capita income growth, India's rising middle class, and people moving from necessities to aspirations and then luxuries. So our theme for consumption space is we will go for 4 types of mega trends within that. The first is consume more as per capita income rises and the frequency and the penetration of certain products go up. That would be mainly, say, for the rural side. Second is consume better. So as people move from unorganized to organized, consuming better brands. The third part is consume well. Brands and products that allow customers a certain option in wellness, healthcare. Those will be part of our universe. And the fourth is consume easy, where trends like quick commerce, UPI payments, financing being available easily, whatever makes it easy for the customers to shop more. So these are the kind of trends that we focus on.
Okay, great. Moving on to banking stocks, I think so far the narration was, banking stocks are much cheaper, probably a basket which investors should be looking at, and things were looking good, but results of certain banks have evoked very sharp reactions or sell-offs in the market. Now, how big a worry are things like unsecured lending for banking stocks, and how do you see the way forward in terms of valuation? They all look very decent still, but how do you see the prospects?
So the credit quality is a very important factor to look for when choosing a banking or a financial services company. While growth and margins are important, so they are the three pillars, but the most important pillar within these three is the asset quality, and we focus on those. Currently, we are not overweight on the banking sector, but wherever we have invested, we have a good concentrated bet. These would be, say, certain private banks who have improved actually on asset quality in this quarter and delivering good growth and margins. And maybe only one public sector bank, which we believe is a leader and would deliver better numbers even in this environment. Some of the companies in NBFCs and in banks have seen pressure on asset quality, which has come mainly from the MFI exposure. So microfinance exposure has been something that is hurting these companies. Now, whether it was a sudden or an unexpected outcome, I won't think so. I think last 2 quarters, there were signs of certain slowdown in collections on the MFI side. So I would say some of these risks were probably unnoticed by the market when we were in a bull run, and those are showing up now.
So overall, so far based on the results and the way it is trending, so you would, are you looking at your earnings estimates differently for the Nifty for FY25 than what you saw in the beginning of the financial year or in January 2024?
So historically, Vardhini, what we have seen is 8 out of 10 years in India, estimates that analysts make at the beginning of the year, they keep revising downwards throughout the year, 80% of the time. And which is why whenever we forecast our models, we try to add a bit of caution in the estimates that we see in the market. So typically we would be, say, 4-5% lower than what the market estimate is. And from Q3 onwards, then it's very close and visible that what Q4 will be. So then that number becomes frozen. So majority of the changes in consensus estimates also happen in the first half. This quarter, we will see about 4 to 5% downgrades in earnings. Now, was this again unanticipated or was it unnoticed? If you see last 2 years, for most of the companies, the top line growth has been in high single digits or maximum say 10% or so.
Yeah.
However, margins have helped a lot of companies to improve their profit growth. So that's why you saw somewhere between say 12% and 20% kind of profit growth, whereas the overall say top line growth was between 7 and 10%. Now, this quarter onwards, there is certain convergence within the two growth rates. So at least the results I saw, compendium that I saw two days back, what I find was the results that have been announced till now among the top 500 companies, the top line growth is about 8% and the bottom line growth is about 7%. I'm not dissecting it within categories now, but say overall, there has been a slowdown in earnings, and this was anticipated, which is why I think for some of the smart hands, they have moved towards more safer havens or areas where there is very high visibility of growth or high visibility of strong growth. Our own estimate today is about 2% lower than what the market is forecasting for the year and even today.
Could you put a number to that?
So I think the market consensus now is at about 1,080 for Nifty earnings for this year end and about 1,200 for the FY26. We would be standing around 1180 or around that number as of now.
Okay.
So we are conservative that way in forecasting. And even when we consider valuation of Nifty, we look at intrinsic value rather than just giving it a PE multiple. So we look at assets, holdings, cash flows of these companies, and then come to a Nifty valuation. So frankly, we've been a little cautious the moment Nifty went above 24,400. It went all the way to about 2,000 points higher than that, and it's now coming back to the number that we have as a fair value of Nifty. In mid caps and small cap, I think expectations are even higher for many of the stocks. Stocks are at 100 PE or 80 times price to earning ratio. I think that's where the worry is also, that even if the companies meet expectations, they don't give enough compounding to the investor, because they will just be growing with the earnings growth rate or just matching the growth rates of profits.
Okay, so when you say that Nifty is coming down to fair value, so are you calling the markets cheap, or are you saying it's rightly valued? So what is your take?
So here is how we look at it. So Nifty, we look at intrinsic value. So where is the intrinsic value? Typically, in a bull market, Nifty can trade much higher than its intrinsic value. In a bearish market, or where we are seeing concerns coming in economy and corporate cycle, we see Nifty moving much below its intrinsic value. So intrinsic value doesn't say that it is, I mean, since Nifty is here at the intrinsic value, it doesn't say whether we are expensive or cheap. We are just fair value at this point of time. I believe we still are in a bull market, and we would, after this correction, we would start moving up. So Nifty, I'm positive on. Large caps, I'm positive on. However, when you look at valuations and growth projections in mid caps and small caps, there are signs of worry. However, it is still difficult to generalize because there are vast categories, like especially small cap has about 250 companies. Many of the estimates are still stale, so they are not refreshed because very few analysts would be tracking them. How we look at it is, in small cap basket, if there are 100 balls in that basket, 80 are green, 80 are red and 20 are green. So if you pick up one randomly, it is likely that it will be a red ball. But if you want to get a green one, you have to put a lot of effort there. In a basket of 100 of large cap, 50 are green and 50 are red, because we are at fair value. So if you pick up one, there's a 50-50 chance randomly picked up. But if you want to find a green, it is easier today than looking for a cheaper stock in small cap.
Okay. So market cap wise, it was well explained. In terms of sectors, do you see any spaces where investors can find some sort of value, or fair value at least?
Yeah. So what we do is we have a bit of contrarian streak within us. So we look at areas where, if the selling is overdone, and we hunt for those areas which have recently not attracted investor attention as much. See, last year, areas like capex, defense attracted a lot of investor attention, and they went into high valuations very quickly. At the same time, there were areas within healthcare, consumption, banking, financial services, which people were not much interested in because they were going through some slowdown and all. These are now areas which are very fertile to start hunting for ideas. Not that you buy the whole basket, but these are areas where you can spot opportunities for getting a company with a good quality, good growth, and at a reasonable valuation.
Okay. So you just said that, after this correction, you believe that the market is in a bull run and you expect the market to move up. Now, what do you think are the three biggest risks to this, belief?
So if I look at market-wide, I would say first risk would be that if we enter into a global slowdown, a significant slowdown globally, and if because of certain wars which are going on, they persist and we see inflation resurface in a slowing economic environment. So kind of a stagflation kind of scenario. I think that's one global risk that is there. The other risk I see is in many pockets where investors are invested, valuations are high and expectations are also very high. So that's where I see some disappointments that can come. The third and my biggest worry is that in the past few years, a lot of new investors or new traders who have come into the market have chosen to directly move into futures and options and leverage trading and investing. I think that is not a healthy sign. These investors can get hurt even at a small correction because they are leveraged on that in the market. So these are the areas that worry me about a deeper correction that can come in the market triggered by one of these.
Okay.
That would be the...
Okay, great. Okay. Thanks. Thanks, Nimesh. Thanks a ton for your time. Very good conversation. Thank you so much.
No, thank you for the interesting questions. It was very nice talking to you, Vardhini.